What's going on, guys? Just like I promised, we're going to get into the balance sheet and financial statements. In this video, we're going to talk about how you guys can study these financial statements, really understand whether the company is worth it for you guys to invest in, or if there's some red flags that you can find to prevent yourself from making an investment decision that can eventually cost you some money in the long run. We're going to look at the numbers. We'll start with the basics for now and then dive into the nitty gritty at a part 2 series of this. But the very basics is essentially all you need to get through the financial statement and to give yourself a better understanding of whether this company is something you want to invest in. Every financial statement has 3 parts, okay? There's the balance sheet, there's the income statement, and there is the statement of cash flow. So when we're looking at these financial statements, we really want to take a good dive and look in these 3 categories: balance sheet, income statement, and statement of cash flow. Now, when we're looking at the balance sheet, we have a few things that we need to take a look at. The balance sheet, this is where the key information and pretty much all the good stuff is found. And all it really means is this is where the company balances their assets and liabilities. Assets are broken down in a few categories. When you're looking at assets, we have current assets. So current assets is assets that can be turned into cash within 12 months. And then we have long-term assets. Long-term assets are things like properties, headquarters, things that can't really be flipped into cash very quickly. And then obviously we have non-tangible assets. Now with non-tangible assets, this is pretty much things that don't have physical presence. There are things like brand awareness. You've over the years you've built some sort of value for your brand, and that's what non-tangible is. Okay, so again, current assets are things that can turn into cash within 12 months. Properties and headquarters are long-term assets, and brands and things not tangible are other types of assets. Now, when we're looking at liabilities, there's a few liabilities as well, but the most important liability that we really want to take into consideration is current liability. We want to look at current liabilities because this tells us that there's debt that needs to be paid within 12 months. This is good. This is great. Now that we're looking at all this is the balance sheet. We have assets and we have liabilities. This is the main part of the balance sheet, and the role of the balance sheet is to balance the assets and liabilities. Now, what formula we can use to establish whether this is a good company with a good balance assets to liabilities ratio is we take the current assets, we divide it by the current liabilities, and whatever this figure is, it needs to be above 1. Okay, so we need this figure to be above 1. Let's take a look at an example here. So we're going to dive into, now we're going to take a look at Shopify, and we're going to take a look at this balance sheet, and we're going to figure out whether their current assets and liabilities is above the figure that we're looking for. Okay, their current assets right now is sitting at around 8.5 million. Okay, and their current liabilities is 702,000. So we're going to take this and we're going to come down here and we're going to write it out and see what the figure is that we're dealing with. So the current assets is 8539320 divided by the current liabilities, which is 702,733. This equals, so the figure we have here is actually 12, so well above that 1 that we've identified for the rule of thumb. So what this information actually tells us is that Shopify as a company has very little liabilities, and just based on their assets alone, they can pay off all their debts 12 times. Obviously, this is something positive. It's well above the number 1 that we are looking for. By them being able to pay off their debt or their liabilities 12 times over and over again, it is a very positive thing to know. Now, the next thing we want to look at is the income statement. Okay, the income statement is where the part where you often hear top line and bottom line. This is important because we talk about the total revenue and then we subtract the expenses and we get the net profits that the company makes. The top of the statement is the total revenue. All right, so the top of the statement is total revenue. The bottom of the statement is net income. So this is where after everything is reduced. Okay, so when you talk about the bottom, this is net income. All right, so the bottom of the statement is net income, and that's after all expenses have been deducted. Okay, now when we're looking at income statements, there's cost of business, which is vital for things to run. And then there's operation expenses. So these fall under wages and things that could be controlled. Essentially, you can cut staff, you can cut wages, whatever the case may be, to bring down your costs and your expenses a little bit. But the cost of doing business is, for example, if you own a lemonade shop, you need lemons to make lemonade. So lemons, the cost of lemons is going to be your cost of business. And you need those things because they're vital to your business, and without it, the business can't run. Okay, so that's what cost of business is. And then operating expenses are the people you're essentially paying for, wages, etc., that could be reduced and kind of managed. Okay, now one calculation to use when we're looking at these is operating income divided by total revenue times 100. And this gives us a percentage. Ideally, we want this percentage to be above 15. Let's take another example and look at Shopify's income statement. Perfect. So we got Shopify's income statement. All right, now let's take a look at Shopify's income statement. Okay, so what we need to find the operating income. Okay, so the operating income is right here. All right, that's the operating income. The total revenue is found right here. So we have to take these two figures, divide them, multiply by 100, and we'll get a percentage. So now let's plug these numbers in and see whether we get a figure. So the figure we're looking for here is actually above 15%. Okay, that's the figure we want. We want to make sure once we do this formulation, we get a 15% above. Okay, so let's get into it. So the operating income here is actually a minus 277,881. Now you divide that by the total revenue, which is 5002450 times 100. You're getting a negative number here. Now TTM means the trailing 12 months. If we go back and actually calculate their last reported yearly numbers, let's take a look at that one. Okay, so let's say 268,643 divided by 4611856. Okay, and that number is coming from here, guys, just so you're aware. We get that, and we get 5%. Okay, so it's still well under the 15% that we're looking. We'll make note of that, and we'll move on to the statement of cash flow now. Okay, so we established that the balance sheet works for us. Their total current assets versus their total current liabilities was a number that we could work with. It was above 1. Now, when we're looking at their income statement, this doesn't really add up here. We're looking at least 15% or at least above 10, and we actually have a 5% or a negative number depending on if you're using the trailing 12 months. Okay, so now let's dive into the statement of cash flow, and then we can really get going on whether the company is creating cash flow going forward or actually burning cash. All right, so diving into the cash flow of Shopify, the main thing we want to look for is, does the company have increased free cash flow year over year? So is their cash flow actually increasing year over year, or is it, or the cash flow is actually decreased? So one thing that is something that you guys should pay attention to, especially when a lot of you guys are investing in these bio companies, you got to see whether that cash flow is negative. And if it's negative, it's something you guys really want to start paying attention to. If it's a good company and it's got future outlook and you can see the number is negative but slowly becoming less and less, that's great. But by us looking at Shopify here, the free cash flow from 2018 to 2020 is increasing. All right, we have minus 32,000, 8,000, and then 382, and then December 2021, 453. So we can see free cash flow is actually increasing. This is the trailing 12 months. Not something I like to look at. I like to look at the actual numbers that come out. However, you can see the free cash flow is increasing, so something to take into consideration and something to think about. All right, so no formula here really. It's just a matter of looking at the cash flow and understanding whether they're increasing or decreasing, and now you plug everything in. Okay, so when it comes to Shopify, we knew that under their balance sheet, they had a total current assets and total current liabilities of, I believe it was 15. So that figure was a check for us. Now, when we're looking at their income statement, the income statement was a 5% or minus 5%. So that's a no-go for us. And cash flow was increasing. Okay, so this is something that's positive that I'd like to see. I want to see cash flow increasing, and I like the fact that their current liabilities and assets is well above 1. The only place this has issues is right here, okay? This is where the problem is. Now, I could kind of invest in this because, you know, they have cash flow, their current assets and liabilities add up, but there's other companies that you can do more research on to see, okay, maybe their income statements, you know, after all their operating expenses and everything, is actually a positive. Okay, so to put it in perspective, let's take a look at Apple's income statement. All right, now we're looking at Apple's income statement. Okay, so let's pull up a calculator here, and the formula again for income statement was operating income divided by total revenue times 100. Okay, so let's take a look here. Operating income for Apple is 118 million, and their total revenue is 387 million. Okay, so let's plug this in here. So operating income was 118,329,000. Okay, you divide that by 387,542,000. You get 30%. Okay? So in regards to Apple's income statement, we have a number that is greater than 15. So this is great. This is what you should look for. There are companies that you can find that have above 10-15%, and this is really what you need to pay attention to. So do your research and really understand how these things kind of balance together. And lastly, the last thing you want to look at is something called, you know, quality analysis. So quality analysis is, does the company that you want to invest in have brand recognition? For example, Apple, Coca-Cola, Nike. These are, you know, very well-known brands, and they have brand recognition. Obviously, the second thing you want to look at is you got to check, you know, who's running the company. Maybe do some research on what that owner or what that CEO, what track record they have, you know, what companies have they ran before, how good have they ran those companies, have the companies they've ran just been going down the drain, or have they really accelerated the company's growth? And obviously, lastly, the things you want to look at is what's going on in the media today, and what does the future outlook for that company look? You know, we live in an environment where, you know, at the moment, it looks like there's you know, we're excelling. There's electronic cars that we're trying to get into. So these are things that you have to really, one, believe in yourself, and two, understand where the future outlook of the world is going, so you can kind of make the educated decision to whether or not you're going to invest in that company. All right. So this is just the basics of looking at financial statements. All right. So we talked about balance sheet, we talked about income statement, and we talked about statement of cash flow. Okay, so very key things that you want to pay attention to. And when you check any website, these three things are going to be right there: income statement, balance sheet, and cash flow. And you want to go through that. You want to understand what these numbers mean, and plug in the formula and see if it fits. If it fits, great. If not, maybe it's not the best thing for you to invest in. Okay. Now in part 2 of this video, we're going to really break everything down and kind of bring everything together again. Okay, so in last video, I showed you guys how you can kind of use MARKETSMITH to come up with some stocks that you want to invest in long term. Now in this video, we broke down some financial statements that you guys can get into and understand that aspect of it. And in the last video, we're going to kind of combine everything and really give you more details on everything like that. All right, so if you did find value in this, go ahead and smash that like button and subscribe so you can catch the last episode of this series. And as always, thank you guys for watching, and I'll catch you on the next one.